The broadcast is now starting. All attendees are in listen-only mode.
Hey, good afternoon, everyone. Welcome to the Mini Storage Messenger webinar series. I'm Keith Rawson, the social media coordinator here at Minico, and we're delighted to have you in the audience today. As most of you know, this is one of many informative webinars planned for the self-storage owners, operators, managers, investors, developers, and other industry professionals. Today's webinar is, we'd like to thank our sponsor today, Safe Harbor Equity, for their sponsorship of this free event. And today's speaker is Mr. Peter Ingersoll. Right? Mr. Ingersoll is a registered investment advisor and CCIM designee who specializes in creating maps for his clients to safely navigate the treacherous investment waters of commercial real estate. He has 30 years of experience as a builder, developer, trust officer, investment banker, and commercial real estate broker. Peter is the vice chair of the California Self-Storage Association and serves on the board of directors of the Northern California chapter of CCIM. He is a graduate of the Wharton School of the University of Pennsylvania and a regular columnist on the topic of distressed commercial real estate for the Registry Real Estate Journal, broker, banker, and the Mini Storage Messenger. His latest book is The Real Estate Tsunami Survivor's Guide. This year marks the 31st anniversary of the Mini Storage Messenger. The Messenger provides the self-storage industry with in-depth news and information. Each issue of the Messenger offers cover stories and feature articles on the most timely industry topics and trends. Monthly columns contributed by industry experts and accomplished business professionals address a wide range of topics, including security, facility operations, technology, legal issues, legislative issues, construction, and development. We also publish a variety of other self-storage data sources like the ones you see listed. For more information, please visit www.ministoragemessenger.com. Okay. Now, we invite everyone to submit questions throughout the webinar. Simply type your question in the question area and click send. Now, depending on the question, we will answer it privately or to the whole group. We will try to answer as many questions as we can during the question and answer period at the end of the webinar. Now, we are also going to mix things up a little bit as well, too, and we're going to try to take some questions during the course of the webinar as well, too. Okay? So, for those individuals who do have a question during things, please feel free to submit them, and I'll try to get them to Peter as soon as possible. Okay. Now, today's presentation is being recorded, and it will be available for viewing on demand from our archives at the ministoragemessenger.com. Today's presentation should run about 45 minutes, with the remainder of the hour open for questions and answers. And now I'd like to turn the presentation over to Peter. Peter, how are you doing today, sir?
Good morning, doing well. Good morning, everybody, and thank you for spending your lunch hour with me. I am very happy to be giving this presentation with Minico and to the self-storage audience, and I'm very grateful for Minico's support. I wanted to give you a little insight onto why I wrote the book and the purpose and what I hope the book will accomplish for you and any other listener. In 1979, 5 years out of college, I was a aggressive real estate developer and sensed that something was wrong and I didn't know quite what it was. And I found a book one night in a bookstore called The Coming Real Estate Crash, and it literally saved my life. It gave me the information to understand what was happening, and I was lucky enough on Thursday, October 3rd, to be able to sell my small portfolio of investment property. And on Friday, October 4th, 1979, Chairman Volcker, the chairman of the Federal Reserve at the time, jacked the Federal Reserve rates up 2.5%, and then another 2.5%, and it essentially killed the real estate market. The lesson for me is that if you're a mouse, as all small real estate investors are, you have to know where the elephants are playing so you don't get stepped on. And the elephants I'm talking about are the global movement of funds that translate into long-term interest rates. The other reason I wanted to write the book is I wanted to be able to look my clients in the eye and tell them with a surety of exactly what happened, what is going on now, and what they can do. You probably all remember back to August, September of 2008, and it literally looked like the world might end, and frankly, it almost did, at least financially speaking. The book has something for everyone. Real Estate Tsunami Survivor's Guide is written as a guidebook. It's indexed, it's chapter outlined. It does have a storyline, and I think you'll find it entertaining, but you shouldn't consider it daunting. You can skip around, read one chapter at a time. My Republican friends think I've become moved to the right and I'm ready to be recruited into the GOP, and my Democratic friends think I've become an anarchist. So I assure you, somehow I found a middle ground. There's something for everybody. Now, I wanted to share with you a recent experience I had at the NCAA Wrestling Championships in Philadelphia before we really get into the meat of this. While I was at the Wharton School of Pennsylvania, I wrestled, and there was a reunion of sorts back in Philadelphia. This is the first time this event was held in Philadelphia, and one of the most amazing things I've ever seen, and you can see on the screen here, a one-legged wrestler was a national champion at 125 pounds. Anthony Robles, at least that's how it's pronounced if you're in Arizona State country where Minico is. If you're back east, it's Anthony Robles. Just one of the most amazing athletic performances I've seen in my life. He competed against some of the best in the world and dominated them all. So I just wanted to share that with you. It was an experience that was pretty amazing for me. Now, getting on to the material, the topic today is the race between rising interest rates and rent growth. And I want to be really clear that we are in a race, and there are a lot of structural risks for investors, but I also realize that there are a lot of different listeners and participants in this webinar. Some are buyers, some are sellers, some have no debt on their property, some have a lot of debt on their property, some are small operators, some are regional, and some are REITs, and each one of these groups, participants, have a different perspective. And while there's something for everyone here, the book is primarily focused on the smaller investor, however that's defined. That could be someone with, 3, 5, 10 properties. And I'm pretty much going to focus on the risk that both buyers and sellers face in this marketplace. The REITs and the large shops, I figure, have the resources to make some of those decisions, but my hope is that we'll bring some of this stuff down to the smaller operators and to help them. Now, the book is bearish for a reason. A lot of the popular press these days is touting sunshine and recovery and all is well, and we should come back out and start buying real estate like they're hot potatoes. Well, I got to tell you, there's some significant structural risks in the marketplace. And if you're not aware of these structural risks, it's likely you can get in some real trouble. Now, it's not all gloom and doom, but I just want to announce up front that the purpose of the book is to point out some of the structural risks so that as you're making decisions, you can be forewarned as forearmed. Now, because the global movement of funds impacts commercial real estate interest rates, the dynamics that we're examining are really a very large elephant, and it can be daunting, much like trying to figure out social media can be daunting. But I think it's very important to begin to understand how our global financial system links together in order to make appropriate investment decisions. And what I hope to do is touch on a couple pieces of the elephant today so that we can triangulate and kind of figure out and allow you to figure out how this impacts you. The two issues I want to focus on today, which is the rising interest rates versus rent growth, really are an issue of inflation and interest rate risk. Inflation is not uniform, and it has a lot of different meanings in different situations. But the first place we have to look at is the money supply. Inflation takes on a lot of meanings, but if you don't have a growing money supply, you can't have inflation. And the next slide will show where we are in that regard. Back one, Keith, sorry.
No worries.
There we go, thank you. Now, it's real simple. If you don't have a growing money supply, you can't have a recovery. It really is that simple. So let's take a look at first at the money supply, which is a little esoteric, I understand. But there's an interesting thing going on with this graph, and this graph is published by a group called ShadowStats, www.shadowstats.com, and I would recommend you subscribe to it. It's a pretty cheap newsletter. And you'll see the red and the blue line. Well, interesting thing happened. The Federal Reserve used to track at M1, M2, and M3, and then in 2006 announced it was no longer going to track M3 for purposes of cost efficiencies. Well, M3 is the broadest measure of money supply. So let's quickly look at what the M1, M2, and 3 means. M1 is basically cash and checking accounts, pretty simple. M2 includes M1, but it includes time deposits, savings accounts, money markets, and other things. Now, M3 includes large institutional deposits and repo positions, repurchase agreements between large institutions, and most importantly, euro dollars. And it is the broadest measure and valid measure of money supply, but in 2006, the Federal Reserve decided to stop tracking it. The interesting thing you can see here, as in the 2008 crisis in September of 2008, the money supply plunged radically. And as you recall, the Federal Reserve pulled out all the stops where you can see the dark black line, M1, and pumped as much liquidity as they possibly could into the system. And it had no effect. It had no effect because there was more money leaving the United States than there was coming into the United States. And if you look at the blue line, even though it's trending up very sharply, it's still below zero. And we can kind of feel this in our economy. The economy is turning around. Money supply is coming back to about even. And there's some other broad implications there. In 1979, when I mentioned Chairman Volcker jacking the rates up, the Federal Reserve literally controlled 100% of the money supply. Today, the best that can be said is the Federal Reserve controls maybe only 50% of the money supply. And the difference is what's sometimes called the shadow banking system, which is the private equity and private debt that flows around the globe. Now, the other aspect of the creation of money, which you heard a lot about in the popular press, is lending. You may or may not have heard of the multiplier effect, but when banks take deposits and make loans, there's a multiplier effect, and they create more and more deposits and more loans. Well, that's not happening in the current cycle, and hence we're not really recovering that rapidly. The multiplier effect isn't happening because loans aren't being made. Now, the popular press has talked a lot about QE2, and the next slide will look at that pretty quickly. We are fortunate in the commercial real estate market today that 10-year treasuries are at 3.5%. If 10-year treasuries reverted to its historical average, which we'll discuss in a moment, today the picture of our marketplace would be decidedly different. Well, how is it that treasuries can be so low? And the answer is very simple. Just as in the residential marketplace, 97% of all mortgages are underwritten and issued by Fannie Mae, Freddie Mac, or FHA. That is, 97% of the mortgages are issued by the government. So too in the commercial side, interest rates are highly subsidized by the Federal Reserve. Now, how does this happen? Essentially, quantitative easing, which has been mentioned in the press, is the Federal Reserve creating money out of thin air and buying treasury securities. And according to the Financial Times, that 2/3 of their $1.6 trillion program is being invested in treasury securities with maturities of 4.5 to 10 years. Exactly those maturities that the commercial real estate markets use as indexes when making loans. It's no surprise that the Federal Reserve is targeting these maturities because 51% of all commercial real estate debt is held by banks. Banks cannot afford to take the losses on those loans. And so the point here is to reflate commercial real estate prices so that banks don't have to suffer losses, and hopefully a normal market can return and lending will then commence. What this slide, the question that this slide asks is what happens when QE2, quantitative easing 2, ends in June? Before quantitative easing started, you can see on the left, the Fed bought a small portion just for liquidity purposes. 50% were purchased by foreign, mostly governments, and the rest of us are domestic and insurance companies and other buyers of those securities. Under quantitative easing, 70% of all Treasury securities are being bought by the Fed. As I mentioned before, 2/3 of that are all in the long end of the yield curve, the 5- and 10-year maturities. At the end of June, who's going to pick up the slack for that 70%? The Federal Reserve can control the discount rate, and they can control the Fed funds rate, but they cannot control the rate for the 10-year Treasuries. The 10-year Treasuries, the price for those are set at auction every week, every day. And if there aren't buyers at the end of June for those Treasuries, the interest rates will have to go up until it does attract buyers. Now, as I mentioned before, if interest rates go up, this has dramatic impact on the commercial real estate markets. The events of 1979 and the bullet that I dodged back then was the fact that the interest rates spiked overnight. I don't expect that to happen in this particular case, although it may, but a long sustained period of rising interest rates, whether it's over 1 year, 2 year, or 3 years, has definite impact to the value of your real estate. Now, there is some talk that quantitative easing 3 will continue, but I think this is politically unlikely. We've just seen the showdown in Wisconsin. The federal government almost shut down its entire budget because of lack of funding. I don't think there is the political will to have the Federal Reserve continue on this buying spree with money made up out of thin air. Additionally, the European Central Bank has just raised their rate, and there's now talk that the Federal Reserve is looking at raising their rates in early 2012. So let's look a little bit more granular at the local markets, the housing market. That's near and dear to all of our hearts, and housing prices have fallen a lot, but here's the problem. They're starting to fall again, and they will continue to fall again, and the reason is very simple: supply and demand. Barclays Capital estimates are just a little under 5 million foreclosed or soon-to-be foreclosed homes, but on top of that, and here's the real kicker, CoreLogic just issued a report that 22% of all homes with a mortgage have negative leverage. Almost 11 million homes, 10,800,000 homes. Now let's put this in perspective. 4.9 million homes in foreclosure is more than the population of New Zealand. 10.8 million homes that are underwater is more than the population of Austria. This is a huge problem. Short sales are accelerating. They're accelerating because the foreclosures are stalled. All this means is that there's going to be more distressed supply coming on the market. Now, there's some good news here. There's going to be some fantastic buying opportunities for investors and homeowners. The affordability index is coming down. But the point is that the lenders here, in a large part banks, are going to have a hit to their capital. When they have a hit to their capital, they're not going to be able to lend as much, and there's going to be more pressure on interest rates. If they don't have the capital, the equity capital to make loans, capital for the real estate sectors, particularly commercial real estate, will be in short supply and will also provide pressure for rising interest rates.
Peter, I wanted to interrupt real quick here with a question. Sorry about that. I have a question that came in here now. Basically, Mary is asking, how do the falling residential markets impact self-storage?
It's a great question. It could impact it in a couple different ways. You know, here's one thought. Falling residential prices hurt consumer sentiment, and so they're going to spend less. If they spend less, they're going to accumulate less. But the other thing is that if we recognize that the new buyers, the folks that have houses that are underwater and decide to sell on a short sale, the new buyers are going to come in at a much lower price, and many of these new buyers are the young families, the young household formation with ages 25 to 45, and if you know the demographics of self-storage, ages 25 to 45 are the peak years for self-storage use. Why? Because that's in the accumulation phase when families start and bicycles are purchased and you need room and space. The other issue is that statistics and studies are showing that the Gen Y generation are deciding to live in an urban environment, and they are planning their life around a walkable, smaller community and do need self-storage as a permanent fixture in their life. On the one hand, falling residential prices will affect lending and possibly interest rates, and that's the main point. But on the other hand, it'll open up opportunities to find new self-storage customers if you know how to look for them.
And this is actually very true. My wife and I just purchased our second home, and we have been utilizing self-storage for quite some time. So for our belongings, and we're still continuing to rent our unit. We know more than a few people, young families in our generation, that they really are taking advantage of this market right now and getting into the new homes. But they need the space. So it's a very good point there. I think
it is, and if operators can figure out how to get to that younger generation, that new household formation, ages 25 to 45, they'll do very well. The point here is to go back to the mice and the elephant analogy. If these are some of the global events taking place that impact interest rates, and interest rates hurt our values or affect our acquisition decisions, we need to know about them. Now, the next slide shows that there's a huge disconnect between what the folks in Washington, D.C. and Wall Street believe is happening and what's really happening on Main Street. This was an article that focused on Homestead, Florida, that shows the vulnerability of household budgets to rising costs of gasoline, food, and clothing, but mostly gasoline. And I'm going to come back to this point a couple more times. The middle class budgets are a lot tighter than most people want to recognize. And if you look at this chart, you can see that the delinquency rates run from 5 all the way up to 40%, with a lot of red and black dots. The red dots are 10 to 20% delinquency, at least 90 days delinquent. Well, the chances of coming back from the brink after 90 days delinquent are pretty small. Even the green dots are 5 to 10% delinquent. So clearly there's a lot more short sales and foreclosures and pain that we have to go through before the housing market becomes healthy. The point here is to understand that inflation, particularly the rising cost of gasoline, is pushing budgets so hard that it's increasing the foreclosure rate, which is amazing. Now, those younger consumers, 25 to 35, who have not yet purchased a house, they are not in this distress. They are the possible purchasers of these houses in foreclosure and short sale. And I would say to you, it would be a smart move for most storage operators to think about putting coupons in the move-in packages for these young families that move into their homes, either the ones that are sent out by the Chamber of Commerce or your local realtor. The young families that are moving into these homes that have been foreclosed or short sale are the new customers. Now, the next slide talks about the recovery in retail, which is a little bit schizophrenic. Yesterday, the California Self-Storage Association hosted the Northern California Symposium, in which I was fortunate enough to be able to MC. And we had an economist, Hissam Naji, who's the head economist for Marcus & Millichap, and his statistics show that retail spending is up to near the peak levels in 2006. Well, how do we square that with a recent Wall Street Journal article from which this chart came from, that vacancy in shopping areas is rising? Well, a part of the answer is that in some of the exurbs, the Bloombergs, things aren't doing very well. But the other part of the answer is that the internet is consistently taking market share from your traditional retailers. The other thing I believe this shows is that consumption from baby boomers and folks that have been impacted by this housing crisis is down. They are not only are they suffering from the housing crisis, but they're under attack from inflation, taxation, and are extremely worried about cutbacks to Social Security and Medicare. The unemployment figures that are being forecast are really the result of unemployment benefits ending and forced retirement. One of the interesting things with the unemployment is that retirement benefits have surged. Applicants to Social Security are 7 years ahead of their trend. What this means is that for the folks impacted by the retail housing, the housing bubble, they're going to have a harder time bouncing back and becoming the consumers of the past, whereas the younger generation that didn't get caught in the housing bubble and who now have the world before them, they are your best potential customer. Okay, so I would say retail is also highly vulnerable to oil prices. Just as in the previous slide, household budgets were vulnerable to rise in oil prices, gasoline prices, so is retail. And this will probably bring some opportunities to self-storage operators who can find vacant big box retail like a Circuit City or others. If you have a high density population and great traffic count, which most of these retail centers have, you can probably buy these retail locations very cheap and convert them to self-storage. Now, I would give one word of caution. You can't buy on the edge of a development and expect houses to be built. You have to buy in the highly dense, high traffic area that already exists. But there is a possibility that this downturn in retail can benefit self-storage operators.
And this is actually a pretty big trend right now, isn't it, Peter? I mean, especially up in Canada and the Pacific Northwest, we're seeing a lot of self-storage investors going into these empty big box stores and realistically and going in and turning them into self-storage. It seems like a great investment opportunity as far as that's concerned.
Well, it is. The primary limiter, of course, is the clear height inside the store. The clear height is from the concrete to the bottom of the beams. And if you have 24-foot clear height, you can get a two-story building inside that big box. And these big box footprints are typically 45,000 square feet. And so if you can find one, you can put roughly 90,000 gross, or you'll probably end up with 60, 65,000 net rentable. And they typically are in great retail locations. Now, but again, I have to stress that big box retail is highly vulnerable to increases in the cost of gasoline because they depend on a 25 or 50-mile radius to draw consumers. I would caution against buying out on the edge of the suburbs. I don't think you're going to get the growth. The smart operators are moving towards the city centers as much as they can. Now, talking about the differences in operators, the next slide shows that there is not necessarily a level playing field for all operators. One of the things that we forgot about in the asset bubble in 2006 was that real estate is not uniform in its pricing or its risk. This perception was easy to adopt because CMBS financing was pretty much uniform throughout the country, throughout product type, throughout the sector, throughout asset quality. And we all got used to this idea that everybody could get the same loan at the same price. Well, that is a thing of the past. And one of the reasons that REITs are in such good position is they have low cost of capital, ample cash from the public markets, which private investors don't have. Additionally, the REITs have the resources to really explore how internet and social media can be used to drive customers to their sites, which some smaller operators may or may not have. And this disparity is widening. The net result is that the asset classes, both in quality and location, are not being priced the same. PGP valuation, Jeff Schaus, who is an appraiser with PGP Valuation, who specializes only in self-storage, just published a newsletter. And for 8 locations, there has been some cap rate compression, and today they're trading in the 7.5% to 8% range. Average locations are about 75 basis points, trading in 8.25% to 8.75%, and sub-average or C locations are trading into the 9 to 11% cap range. He's seeing the difference in pricing taking place, and it's taking place everywhere. So the net result is that asset classes and location are not priced the same, and that the markets are strongly bifurcating, which the next slide clearly shows. The next slide shows 2 graphs. One is from the Green Street Advisors, which is a research company in Newport Beach, California, that tracks 150 of the top real estate investment trusts, and that's the blue line on the right. And the red line beneath it is the Moody's Commercial Property Price Index, which is also on the left. The graph on the right was published in Wall Street Journal last fall, and the graph on the left is current as of today. There's about a 3-month lag. And you can see that for the REITs, those companies that have access to public capital, they have been on a market burn and have dominated the sales transactions and volumes. But these are trophy properties in dense urban cores. If you compare that to the Main Street commercial real estate, which is the chart on the left, we are back to values in 2002. And you can see it's now trending down again. It's unclear whether we are going to stabilize at this level or go down or rise, but you can see the comment on the screen there. Until the distressed properties are cleared, there's not going to be much upward momentum to value on commercial real estate. And so the question that you have to ask yourself, whether you are a buyer or a seller, is, are we at the bottom, or is there more price declines coming? I happen to be of the opinion that there are more price declines coming, and the next slide will show you why.
And real quick before we move on there, I have a question that came in here. Now, are properties only I love this word, bifurcating, I'm sorry about that, between trophy assets?
That is the most striking, and you can see that here in the slide. The Green Street Advisors is essentially a basket that tracks trophy assets because the REITs are buying trophy assets, but no, they're not. The market is separating between major markets and secondary and tertiary markets. So if you have a B-class property in a major market, that's going to be priced different than a B-class property in a secondary or tertiary market, and so forth. And the same thing with location and quality. And so debt, loans in commercial real estate space are no longer the same for everybody, and so they're no longer homogeneous, and so pricing is no longer homogeneous. And it's very important to understand this as a buyer or a seller. If as a seller, you hear about a transaction in downtown, say Chicago, that sells at a 7.5 cap, that doesn't mean if you're in the suburbs of Indianapolis that you're going to get a 7.5 cap. And that's pretty much been the story for the last 2.5 years why the markets have been stalled. There's been very little transaction volume except for the distressed properties. Okay. Will we see more distress? That's the question, and the next slide really focuses in on that. And I could, frankly, have spent the entire time talking about this slide. This slide is an exhibit from the report issued by the Congressional Oversight Committee in 2010, and these are the maturity schedules for all commercial real estate loans, only commercial real estate loans. And as you can see, we've been through 2008 9, and 10, and I've highlighted this year and the next 2 years, 2011, 12, and 13. And the green bars would represent the real estate loans held by banks. The checkered bars and the red highlights are commercial CMBS, commercial mortgage-backed securities. One thing, Hissam Naji, the economist for Marcus & Millichap I mentioned earlier, and also Kingsley Greenland, the CEO of Debt Exchange, both have commented that all the loans in 2008, 9, and 10 that have come to maturity, less than a third have been repaid, foreclosed, or dealt with. 2/3 have simply been modified and extended. That's approximately $500 billion worth of loans, $500 billion worth of loans that have been extended into that little red box, the 3 years of the highest loan maturities ever recorded in commercial real estate. $300 billion worth of loans are maturing in 2011, 12, and 13. Now, they're not all distressed, but that's a heck of a lot of loans. If you compare that to the projected CMBS originations of $45 billion, the originations in CMBS only represents about 15% of the total. And going back to my slide before, the housing market, if housing market impedes lending, or if lending fails to pick up, there's going to be a vacuum to find lenders for those green bars. Now, it's interesting that even though the default rate on CMBS is rising to just about 10%, the default rate for the light blue sector, insurance companies, hasn't moved. That's why insurance companies could perhaps be one of your best friends going forward. Now, this chart, you'll notice that in 2013, the maturities from banks begin to diminish, and by 2015 drops off fairly significantly. But also notice in 2015 what happens. The maturities for CMBS swell dramatically. And let's remember that these maturities in 2015, 16, and 17 were made at the peak of the bubble, at the highest loan-to-value ratios, the lowest debt coverage values, at the highest appraised prices. It's my belief that there's going to be a lot of discounting, a lot of distress in these loan portfolios when they come due. Now, the hope of the Federal Reserve and the FDIC is that the low interest rate environment will reflate commercial assets, so the losses in the next 3 years will be minimized, and certainly the losses in 2015, 16, and 17 will be minimized. But this is a delicate balance. This is a balancing act of supply and demand. If we have a little under $1 trillion of loans maturing in the next 3 years, in addition to the $500 billion, so that gives us $1.4 trillion of maturing commercial loans in the next 3 years, will they hit the market all at once and crash the market, or will they be able to come in a little bit at a time and be able to be absorbed? A lot of the media talks about a lot of the abundant capital sitting on the sidelines waiting for buying opportunities. Well, given the small amount of inventory that's coming to market, there does appear to be a lot of equity capital, but if this $1.4 trillion worth of commercial real estate loans hits the market all at once, it will crash the market. Now, I think that we will be lucky to hold the pricing levels as shown by the Moody's pricing index, and that there will be many, many buying opportunities. But this graph is a word of caution to believe that we are at the bottom and it's only up from here. In some markets we are at the bottom, in some markets we aren't. In some sectors we are at the bottom, in some sectors we aren't. We have to remember that real estate and debt is not homogeneous. That's one of the bad habits we got into in the price bubble. Now, what happens if interest rates rise? What happens is that your value tomorrow will be less than it is today. And in order to give you some context about where we are with today's interest rates, today's 10-year Treasury is approximately 3.5%. The average 10-year Treasury in the last 20 years has been about 5.5%. Still really cheap money. Over 30 years, it's been over 7%, And since it's been tracked in 1962, it's been around 7%. If the 10-year Treasury goes to 5.5%, which is still cheap money, that is almost, not quite a doubling, but probably 60% higher. It will crush the recovery in commercial real estate markets. And one thing about the law of large numbers, it will always return to its mean. The only reason that the 10-year Treasury is at 3.5% today is because it's being subsidized by the Federal Reserve. The other interesting thing that's happened, you can see by this chart, is that the cap rate compression, the spreads between the 10-year Treasury and what the investors needed as yield during the boom, you can see compressed down below 2%, now is back up to 4.5%. If you have 10-year Treasuries reverting to its average, 20-year average of 5.5, and you add a 4% spread, the generalization is you have a 9.5 cap rate for non-distressed assets. Today, as I mentioned before, the cap rates in urban areas are sub 8%. What happens if you buy today at an 8% cap rate and interest rates revert to their historic mean? Vince Lombardi, who was the legendary coach of the Green Bay Packers, loved to coach the basics. He would start every football camp off, veterans and rookies alike, with the phrase, "Gentlemen, this is a football." Well, fundamentally, we have to understand that real estate is a bond. If interest rates go up, values go down. The whole point of this talk is to talk about the race between high interest rates and rents. And let's take a look at the next slide and just shows you the impact between income and interest rates. If interest rates go up 50 basis points, that is 0.5%, it essentially reduces asset value by 5%. So a move from an 8% acquisition cap to a 9.5 exit cap is a 15% drop in value. But that value is not symmetrical when we look at the income. What you need to do is you need to drive net operating income 15%. In order to do that, you have to drive your top line 20%. So if you believe that there's a possibility interest rates could go up and you're buying at an 8% cap today, you have to feel very confident that you can drive gross rents more than 20% in order to maintain your value. Now, I'm not saying that interest rates are going to go to 5.5%, but it's pretty hard to argue with the law of large numbers. But this will just give you an idea of the relationship between gross income and movement in interest rates. As we touched on inflation, and unfortunately today we don't have a lot of time to go into details on inflation, but inflation is not the same. The first thing you have to do is understand the true level of inflation. And again, the first chart that we saw with the money supply, Shadow Stats tracks a lot of government reports, and what he does is a unique phenomenon. He uses gap accounting to recast and recalculate government reports to actually try to get to the bottom of it. And if you go on there, if you go on to the Bureau of Labor Statistics that publishes the CPI index and actually look at your numbers, you will find that in the last 40 years, inflation on average has been averaging 4.85%, not the 2% core inflation that has been published by the government and in popular press. The true level of inflation is running far higher, and that makes it so much more important to have pricing power. Okay, the internet, typically pricing power is driven in self-storage by visibility and population density. In the book, there's a whole chapter on pricing power. It's a little bit nebulous concept, but basically it means you have excess demand over supply. Well, what we've learned in the last 3 years is that in virtually all markets, we've built enough self-storage to cover the supply. We have enough supply out there to handle the current needs, and now it's demand-driven. And so now self-storage is facing the same sort of competition that every other sector has faced, and we're kind of sad that the honeymoon's over. Prior to the year 2000, you could build self-storage anywhere, and demand always outstripped supply. Well, now we finally built enough supply. We have a new dynamic. It's not a new dynamic for real estate, but it's a new dynamic for self-storage, that we actually have to compete to get new customers. It is very important to have high visibility and population density, and by inference, traffic counts. But what's emerging as a very important variable is the internet to attract new customers from beyond the trade area. So pricing power in self-storage is affected a lot by drive-by visibility, population density, and also the third leg of the stool is now internet. It's not realistic to think that price increases will come from cap rate compression in this distressed market. Therefore, if you're going to buy a property today, I don't think it's realistic to assume that you can flip it quickly in a couple of years. Now, if you buy it from a foreclosure from a bank and get a great price, that might be possible. But essentially, if you're buying in the market today, my advice to you is to be prepared to hold it for 10 years or longer to get past the last of the distressed maturities. If you go back to that graph and see where those maturities come back down, it's 2018 before the last of the distressed real estate is going to mature and roll off the books.
Peter, I have a quick question. We have a quick question that came in there. As far as the real estate and housing recovery is concerned, when can we expect it to be fully recovered from when the bubble bursts? And how long is 2018 the kind of like what we're looking at as far as the full recovery is concerned?
A great question, and it's really important to differentiate between residential and commercial. I think, my personal opinion, for commercial real estate, it's going to take till 2018 to recover. Now, residential real estate is probably going to recover a couple of years ahead of time, and it's really price point driven. There's a lot of real estate practitioners out there that are doing fix and flip. They're buying buildings on the courthouse steps, fixing them up and flipping them, and they're doing quite well. But in a market when prices are falling, they're reluctant to pull the trigger and buy those properties on the courthouse steps. So there is a price point in the various markets that will sell a lot of homes. What the Federal Reserve is trying to do is trying to reflate or buoy up the pricing so that the banks don't suffer the losses. But the marketplace is speaking loud and clear. If you lower the price of housing low enough, they'll sell quickly, they'll be rehabbed, they'll be resold to a new family, and the new family will be able to afford the mortgage because it's not overpriced. So it kind of depends on how long the banking sector and the Federal Reserve wants to play extend and pretend. If the Feds and the FDIC make the policy decision that it's better to keep cheap money out there to reinflate the markets as opposed to taking their medicine and clearing the markets of this overpriced inventory, then it may take longer. But I personally think that that's coming to an end. This year is going to be a very disappointing sales cycle. Already the papers are saying we're going to have to wait till 2012 for recovery. I think the housing market's going to recover in between 2013 and 2015. It's going to take that long.
That's a very good question. So, and good answer on that one, Peter. We'll go ahead and move to the next slide.
Just as an aside, I personally think the faster that this can occur, the faster we can recover in our economy. So I am not a proponent of pretend and extend and to subsidize interest rates to forcibly inflate the asset values, but that's just me. Okay, so if capital is scarce these days, whether you're a buyer or a seller, and you have completely different perspectives. If you're a buyer with a great balance sheet, you're in the catbird seat. If you're a buyer that's trying to scrape together some investors and buy some properties, your ability to buy properties are very much driven by the debt you can get and the price of that debt. If you're an owner of a property that has a low basis and low loan to value, you really have no problem. If you're an owner of a property that has a high basis and a high loan to value, you're probably sweating it a little bit right now. And it's important to understand the different motivations that the different lenders have to understand who might be the best lender for you in any given situation. So let's look at them real quickly. Banks are motivated by, of course, safety of repayment. They want to make a spread over their cost of funds. And let's also understand their cost of funds is not going to be uniform. The cost for lending is not uniform. When banks make a loan, they want to get everything. They want to get your checking account. They want to get everything that you have. They want to broaden their banking relationship. But basically, the loan officer wants to keep their job. They don't want to make a loan where they'll be embarrassed or might go bad, and so they're going to be very risk averse. They're going to ask to collateralize your firstborn child. Now, that's completely different than the motivation for CMBS lending. CMBS lending is a securitization process where you package up hundreds of loans and sell them to investors through Wall Street. That process needs standardization, which they're working on those final procedures now that have not been finalized. They're looking for deal flow because their number one reason for doing securitization in the first place is to make a profit from the spread between the interest rate on the loan and the interest rate they can sell it to the investors. So what CMBS cares about is just standardization and deal volume and the spreads making as much money as possible. So the CMBS market is probably the most eager market, is the best market to give you the easiest money if you qualify. But the CMBS, reemergence of CMBS is not yet in full swing, and even when it does happen, I'm not sure it's going to be able to provide the capital that it needs. Now lastly, before we go on to life insurance companies, we have to ask ourselves the question, what happens in a high inflation or a hyperinflation environment like the one we may be facing? How do banks respond? Well, anyone who's lived through 1979 knows that what banks do is they put you on one-year loans that can be renewed, fully adjustable rate mortgages. The banks in a hyperinflation or high inflation environment do not want to take any interest rate risk and will put interest rate risk onto the borrower. Well, that doesn't do you any good if you can't protect yourself against interest rate increases. CMBS securitization solves that problem to a certain extent. If you can get a loan today, and I've heard of some great deals out there, that deal will last for 10 years, but you still face interest rate risk. There's one segment of the lending community that is not impacted by inflation, and those are life insurance companies. Of course they want safety of repayment, and they want asset quality and credit quality. That's why their default ratios are so low. But you have to understand the motivation of life insurance companies are to match their maturities to their liabilities. And their liabilities, which are their insurance policies and annuities, are all written as whole dollar contracts. Because they are written as whole dollar contracts, they are not subject to inflation. I'm not saying that insurance companies won't raise rates if interest rates go up, but insurance companies, by and large, are not, their loans are not impacted by inflation because the proceeds on their liability side are not impacted by inflation. Now, if you're borrowing from a bank short term, or frankly, if you're borrowing from CMBS, there are ways to hedge risks with credit default swaps and other mechanisms. They're very complex and complicated, and frankly, they cost something. If you want to hedge a 5-year loan, you're going to have to buy that hedge, and you're basically buying an insurance policy. In some of the examples that I've run, if you look at the cost of a life insurance loan, the real cost of that loan is not in the interest rate. The interest rates are comparable. The real cost of the loan is the amortization. Life insurance companies like shorter amortizations, 15, 20, perhaps 25 years. And so it impacts cash flow, but it does not impact the true cost of capital. What I'm saying is that the premium that you're paying in reduced cash flow is worth it to have completely eliminate interest rate risk. Now, those on the call can make their own decisions whether they want to enjoy higher cash flow in the short term and take their risks tomorrow. But life insurance companies are a great source of capital that can be hedged against interest rate risk. Now let me just summarize, and then we'll open it up to some more questions. We've covered a lot of ground, and as I warned in the opening slide, this is a big elephant. We're going to try to feel as many parts of the elephant as possible and kind of triangulate where we are as an economy and hopefully where each of you are individually as investors. But in summary, the real estate markets are bifurcating between cash buyers of trophy assets in dense urban centers and private investors owning Main Street real estate in secondary and tertiary markets. The markets are not homogeneous, the sectors are not homogeneous, and we're going to have to go back to the old-fashioned underwriting. We're going to have to look at each market separately and not just make generalizations on a broad basis. Secondly, the financial marketplace has huge structural risks. There is an enormous overhang of shadow inventory in the loans that depends entirely on an orderly disposition at elevated and subsidized prices. The prices are subsidized by low interest rates. But even though the trophy assets have recovered, the price levels for Main Street commercial real estate are uncertain. I think it's a mistake to assume that we are at the bottom and it's only up from here. There will be buying opportunities, but I would caution against being too aggressive, and I would really look at market by market and asset by asset specific opportunities. As we discussed, commercial real estate debt won't clear probably until 2019. So we have a good 4 to 7 years of buying opportunities, so we don't have to worry, buyers don't have to worry that they're going to miss the party. There will be plenty of opportunities in the next 5 to 7 years. And the timing of this sale of these distressed loans will determine the future pricing. One resource I mentioned before is Debt Exchange. They publish a lot of interesting information. They're one of the largest sellers of whole loans. They publish a lot of information on both loan volume and discount off of face value. They're a good resource to track. If the FDIC and the Fed is successful in smoothing out the landing or having a soft landing where all this distressed inventory can be absorbed on a year-over-year basis, maybe we'll be lucky and the pricing levels will stay where they are today, and interest rates will rise modestly over a long period of time. If interest rates move quickly, or if too much distressed inventory hits the market too quickly, both will result in a crash in prices. I believe we're in a temporary period of optimism, the calm before the storm, as it were. And if you are in a position to secure long, low-cost debt, get as much of it as possible before interest rate rises, and people wake up to the fact that inflation is coming and interest rates are going up. And we've covered a lot of ground. I thank you, and I'm now let's take some questions.
All right. Well, our time is pretty tight on questions. Like I said, but we did have more than a few come through here. First up, we have this question from John Barry. What is your opinion of self-storage operator's ability to raise rents and maintain occupancy to keep up with inflation?
Great question. And Extra Space has been fantastic in issuing a lot of their reports, which I just have to comment. One of the things I love about self-storage is it really is an industry that embodies caring and sharing. According to a lot of the self-storage Extra Space reports, and we don't have time to go into their methodology, but you can raise rents 7% starting 5 months after somebody moves in, and every 9 months thereafter, and you will have no impact to occupancy. This is a little bit counterintuitive at first because we see discounting in the marketplace. Public Storage has got the $1 move-in. There's a lot of different discounting schemes. But the fact of the matter is that the in-place tenants are not going to go rent a truck and move their stuff again for a $5 increase. And Extra Space has done a tremendous amount of research. They test 20,000 customers at once in a control group, and then they do an experiment of 20,000. So they have absolute dialed-in statistical data. And the answer is you can raise rent 7% 5 months after a customer moves in and every 9 months thereafter. And if self-storage operators are not doing that, they're leaving money on the table. The other corollary to that is occupancy level, and there's some debate as to what the optimal occupancy level. I believe that the optimal occupancy level is somewhere between 85 and 90%, probably in the 87, 88% range. That gives you enough inventory. When somebody new calls in, you have something to rent, but 85% of your customer base is in place, and you're raising rents on your in-place tenants. I hope that answers the question.
That was great. We had a really good one that came in here. Thoughts on higher value ancillary services or business models, perhaps office space opportunities for those repositioned retail big boxes?
Is the question meaning you create like an executive suites in a retail big box as part of the self-storage?
That's what it sounds like to me, Peter. Okay,
well then, I've worked with a number of those situations, and in fact, Keith, my latest article I wrote for the Mini Storage Messenger really talks about fingerprint marketing. I'll give you two answers. When you do that, it's a radical departure from self-storage. The whole idea of self-storage is that the person loads it themselves and then they go away, and that's the transaction. I know of many locations that have done well with a lot of different ancillary services, wine storage, executive suites, and so on and so forth. But that's on a market-by-market basis. I haven't seen the ability of wine storage or executive suites, or frankly the cargo bay model, if those listeners who are familiar with, I haven't seen the ability of that to be implemented nationally. So the article that's coming out in the Mini Storage Messenger is really talking about fingerprint marketing, meaning that if you don't have the resources that the large REITs have for social networking, you have to figure out the personality of the town or the immediate market you're in, and then create a service that's for that personality. And so I would say that if there's a lot of contractors looking for space to have a phone next to where they store their materials, perhaps an office would work very well. But whatever ancillary service that you're thinking about providing, you really need to make sure it ties to a demand, a real need within the immediate business trade area.
Okay. Well, unfortunately, that's all the time that we have for questions for today. Peter will be getting back to you all individually. And of course, you can see here on the screen, we have Mr. Ingersoll's contact information, both email and phone number. So if you do want to get in contact with him, please do so. And all remaining questions, like I said, Mr. Ingersoll will be getting back to you individually as well. Okay. Now, Peter, did you have anything else to add today, sir?
No, just thank you very much. I would be very gratified if you read my book, if it gives you some tools, if it gives you some insight, if it gives you just questions to ask your team of advisors, your accountants, your real estate brokers, your attorneys, your feasibility specialists, and so forth. If it gives you one thing to help save you money or make you money, I'd be very gratified, and my hopes are that those listening will be able to take this and integrate this and understand that we are mice and we don't want to be stepped on by elephants.
Good analogy there, Peter. And I do want to thank everyone for attending today, and we hope we provided you with some very useful information. I do want to remind you that we will be emailing everyone in attendance shortly with basically a link to the archive presentation, as well as a special offer to the Real Estate Tsunami Survivors Guide. And once again, I do want to thank everyone for attending today. And Peter, once again, thank you for the great presentation.
Thank you.
All right. I hope everybody has a great rest of the day. Thank you very much for attending.